So there's been a lot of talk in the press recently about Metro Bank and the fact it's in financial difficulties. And there's also some reports recently about US banks getting into trouble. And this may have got you thinking, how safe is your money in bank accounts? You may have heard of the Financial Services Compensation Scheme, but how does it actually work and what does it cover? I'm Carl Roberts, a financial advisor at RTS Financial Planning. And in this video, I'm going to talk through exactly how the Financial Services Compensation Scheme works and what you can do to protect your cash. So cash is still a really important part of our financial planning, particularly in retirement. It's useful to hold cash for short-term spending, perhaps even for 1 to 3 years, to cover those periods that if the stock market does drop significantly, and it usually does every now and then, you can look to take your withdrawals from cash rather than your investments. So what does happen if your bank goes bust? Well, first of all, your bank might get bailed out or merged with another bank. We've seen this recently in Switzerland with UBS and Credit Suisse. There's also the other chance that the government deems your bank too big to fail, and the government could step in and bail that bank out. We've seen that in 2008, RBS, Northern Rock. But it would depend on the political climate at the time as whether the government would feel confident about doing that. So if your bank does truly go bust, there's something called the Financial Services Compensation Scheme. And what this does is it covers your money in a bank account up to £85,000. That's per person. So if you're a couple, you've got a joint account, or you just have 2 separate accounts, you'll get £85,000 protection each. Now, one thing to be really careful with this £85,000 protection is that it applies per banking license. So if you've got a couple of accounts, but the banks are all operating under the same banking license, then you're only covered up to £85,000 in total. So for example, if you bank with First Direct and HSBC, well, they operate under the same banking license. So if you hold over £85,000 with both of those accounts, you'll only be protected up to £85,000. If you hold money with Lloyds Bank and Barclays, they operate under 2 totally separate banking licenses, so you would get £85,000 per bank in that case. The protection would be up to £85,000. Another thing to be careful of is if you use some of these banking accounts from some of the new and upcoming app-only or online-only bank accounts, like Revolut, for example, is they don't technically have a UK banking license. They're classed more of an electronic money supplier. So those accounts are not technically covered by the Financial Services Compensation Scheme. There are certain occasions where the Financial Services Compensation Scheme will cover more than £85,000. And this is usually circumstances where you hold far more than £85,000, but on a temporary basis. So things like if you're selling a home and the sale assets price has come into your bank account, that could be a lot of money sitting there, but only temporary, because you might then go on to buy another home, or you might then gift it out to your children or something. Other things are if you've won a compensation claim, perhaps divorce payment, those sorts of things. So there is cover there up to £1 million for 6 months only in certain circumstances. Now you may be thinking, well, has the Financial Services Compensation Scheme ever been tested? Has it ever been used? Well, yeah, it is used on quite a regular basis because it doesn't just cover bank accounts, it also covers lots of other money products like pensions, insurance, mortgages. So it can be used for those types of things as well. But in terms of protecting money in a bank account, you may remember back in 2008, there was a lot of trouble in the financial world, and quite a few banks went bust. Bradford and Bingley, you may remember them. That was a situation that the Financial Services Compensation Scheme stepped in. Also, you may remember a lot of people had money in Icelandic banks around that time. And again, there was a particular bank, IceSave, where the Financial Services Compensation Scheme stepped in again. Around 20 billion was paid out from the scheme around that time in 2008. So it has been used in the past. Even just last year, if I look at the latest figures, 403 million was paid out to around 67,000 customers. So it is used quite a lot. But what I would say is that the way it's funded is from levies on financial services companies. So the banks, even financial advisors, ourselves, we all pay a small levy. Well, it's not always small, but we pay a levy into the Financial Services Compensation Scheme Fund. And then you've got to think, if there's enough banks going bust in another sort of 2008 scenario, you do wonder whether there's enough money there to cover all eventualities. In the Bradford and Bingley example, the Financial Services Compensation Scheme did have to go to the Bank of England for a loan to cover all of the deposits that they potentially had to protect at that point. So if you do actually need to use the Financial Services Compensation Scheme because your bank has generally gone bust, you don't actually need to do anything. They say they will cover you automatically and you should get your money back within 7 days. If it's not a bank account and you need to use the scheme for some other financial product, like a pension insurance, then you would need to go to the website and apply online, and your case would need to be looked at, so that would take a bit longer. So we know the Financial Services Compensation Scheme is there to help protect your funds in a bank account. But what else can you do to be in charge of your own destiny? The problem with a bank failing is these things can happen really fast. It only needs to get out there in the news and people start withdrawing all their savings and a bank can get into trouble quite quickly. And there's also then the threat that it spreads into other banks that are all linked. So there are some things you can do to just protect yourself a little bit more. Clearly, one of the things is to decide, do you actually need as much cash as you're holding? So be really purposeful with the cash you're holding. Like we said earlier in the video, it should only be there to cover emergency spending, perhaps any large one-off spending you've got coming up in the next couple of years, and also cover your regular spending for about 1 to 3 years, just so that, like we said, if the market does drop significantly, which it will at some point, you can stop the withdrawals from your investments and pensions and take your withdrawals from cash and let the market recover. So they're kind of the reasons why we hold cash. So if you're clear on how much cash you're holding, what can you do to be a bit sort of safer with it? Well, clearly the first thing is to ensure that you don't hold more than £85,000 with one bank or banking license. Make sure you use your partner's £85,000 protection as well. I would say try and spread your money around quite a few different bank accounts, but always hold one of the top big bank accounts in the UK. So that would be the likes of Lloyds, HSBC, Barclays. These are the sort of banks that are likely to be deemed too big to fail from the government, and they would be seriously looking to merge them with another bank if something happened to one of these banks. If we look at some of the smaller banks, there's always the chance that the government could sort of think, well, there's not that many customers, not that many deposits with them, we'll just sort of let them go bust and the Financial Services Compensation Scheme can step in. But if you hold one of the big banks, at least you've got, I think, that extra bit of protection. If you're holding more cash than that and you really can't be bothered to sort of spread your money around that much, then the last resort is to use the National Savings and Investments accounts, so NS&I. This is basically the government's bank. What's interesting here is that any money saved and held in NS&I, so this is premium bonds or their ISA or other savings accounts, the money held there is protected 100%. Well, it's 100% backed by government. So as long as you trust the government, your money should be fully protected. There's not that £85,000 limit. Well, I hope you found this video useful. Please do subscribe to the channel. We're going to be producing a lot more videos in the next up and coming weeks, mainly centered around retirement planning. So yeah, if you hit subscribe, you won't miss any of these.